Imagine this. You got $100,000 to invest. The question is, do you want it to grow into millions or consistently pay you every month like clockwork? If you're like me, you want both. But here's the thing. The path you choose can make or break your financial future. Today, we're diving into two heavyweights. JEPI, the income-focused ETF with a dividend yield that'll make you smile every quarter, versus QQQ, the tech-driven ETF that's been a growth juggernaut over the last decade. Which one's the right move for your $100,000? Stick around, because I'll break it all down, from how they make you money, to the risks, and even how much they could grow your investment over 10, 20, and 30 years. Oh, and by the end, I'll reveal which one could potentially turn your $100,000 into a jaw-dropping $10 million portfolio. Let's get started. So, what makes these two ETFs so different? It all boils down to their strategies. JEPI is built for consistent income. If you're someone who likes the idea of getting steady paychecks from your investments, this one might be for you. JEPI's secret sauce? It invests in large-cap US stocks and uses a fancy tactic called an options overlay strategy. But don't worry, we'll get into what that means in a bit. Then there's QQQ. If you've ever heard someone rave about riding the tech wave, this is probably why. QQQ focuses on the NASDAQ 100. We're talking the biggest tech players like Apple, Microsoft, Google, Facebook, and Nvidia. This ETF is all about long-term growth, and its performance over the last 10 years has been nothing short of phenomenal. But which one fits your goals? Let's break down what they hold, how they work, and most importantly, what kind of returns you can expect. Let's start with JEPI. This ETF is like the reliable friend who always shows up. Its mission? To generate consistent income. It invests in a diversified portfolio of large-cap US stocks, but here's the twist. It uses covered call options to generate extra cash. If that sounds complicated, think of it this way. JEPI is renting out part of its portfolio to make extra money. That's where the 7.24% dividend yield comes from. Pretty impressive, right? But here's the trade-off. While JEPI is great at generating income, it's not designed for explosive growth. If the stock market goes on a tear, JEPI might not capture all those gains because of its option strategy. In short, it's built for stability, not fireworks. Now, in terms of diversification, JEPI spreads its bets across multiple sectors. Technology, 19.61%. 2. Healthcare, 15.89%. 3. Industrials, 13.18%. Its portfolio includes big names like Progressive Corp and Southern Company. And with 138 total holdings, no single stock dominates, which helps reduce risk. If you're looking for a set-it-and-forget-it income option, JEPI's got your back. But what if you're after big, bold growth? Let's talk QQQ. QQQ is the rockstar of the ETF world. It's bold, it's aggressive, and it's all about growth. This ETF tracks the NASDAQ 100, meaning it's laser-focused on the biggest tech companies on the planet. Take a look at this lineup. Apple, 9.13% of the portfolio. Microsoft, 8.20%. Nvidia, Amazon, Tesla. You get the idea. In total, 51% of QQQ is in tech, making it a high-risk, high-reward play. And unlike JEPI, QQQ is heavily concentrated. Its top 10 holdings make up almost 50% of the portfolio. If tech booms, your returns will skyrocket. But if it stumbles, well, you'll feel it. QQ's track record speaks for itself. Over the last 10 years, it's delivered a mind-blowing 363.15% return. That's 3.6 times your initial investment. But remember, there's no safety net here. QQQ doesn't prioritize dividends. It's all about capital appreciation. Okay, let's get into the numbers. How much could your $100,000 grow with each ETF? Starting with JEPI, after 1 year, your investment grows to $107,995. thanks largely to that juicy dividend payout. In 10 years, you're looking at $215,100. After 30 years, you've got $1.2 million, not bad for an income-focused strategy. Now, let's look at QQQ. After 1 year, your $100,000 jumps to $116,570, already outpacing JEPI. In 10 years, you've got a hefty $481,500. And after 30 years? Brace yourself, $10.6 million. That's the power of compounding growth in action. Of course, no investment is perfect. With JEPI, the downside is that its growth is limited. In a bull market, you might feel like you're leaving money on the table. But if you value consistency and lower risk, it's a solid choice. With QQQ, the risk is volatility. Tech stocks can be a rollercoaster ride. Just look at what happened in early 2022. But if you can stomach the ups and downs, the long-term rewards could be life-changing. So, which ETF should you choose? Here's the bottom line. If you're looking for steady, reliable income, JEPI is your go-to. It's perfect for retirees or anyone who wants consistent cash flow without losing sleep over market volatility. But if you're after big, long-term growth and you're willing to ride the waves, QQQ is the clear winner. With its focus on tech-driven innovation, the potential for massive returns is undeniable. And here's a little tip. Why not split your investment? A combination of JEPI and QQQ could give you the best of both worlds, income and growth. Now that you've got the full breakdown, which ETF will you choose for your $100,000? Let me know in the comments below. And if you're looking for other ways to build wealth, like investing in real estate with just $10,000, check out the video on your screen now. If you found this video insightful and informative, like, share and subscribe. Thank you for watching.